Hi, this is Efrem Hoffman, broadcasting live from NakedSwanTrading.com on May 9th, 2012 at 2:16 p.m. The chart that you're seeing on the screen right now is a high-definition risk map of the symbol JWN, which is Nordstrom Incorporated. It is, definitely getting hit recently as the Consumer Discretionary Index, XLY, has been hit. It also appears to be one of the more dangerous players inside, like, if I compare it to, let's say, Macy's and Saks Fifth Avenue, it looks as if Macy's and JWN seem to be the stocks that are, maybe under the greatest fire from the point of view of surprise. Okay? Now, the whole idea of risk windows is to try to identify quick shifting events or events that are going to be secular in nature in the opposite direction of the most recent trend for an extended period of time, and also to be occurring around a time when there has been a lot of bullish behavior as well as a lot of news reports that have tended to allow that equity to support itself at lofty levels, okay? Or if it was a stock that we were looking at to discuss a short covering rally, then obviously negative news that kept it at lows for an extended period. This just happens to be an equity that has been supported by strong price gains and some supportive news as we progressed into the earlier part of this year. I do believe that what the risk map is now telling us at NakedSwanTrading.com is that not only will sentiment change to the downside, or at least much less supportive of any kind of sustained rallies without sharp breaks in volatility to the downside, it is also telling us that this equity will be less resilient to negative news, and actually sometimes be impacted when good news comes out. So really what this risk map is telling us is not just a change in sentiment of human behavior, but a change in the bias of how the psychology of the decision maker is going to be twisted to become more bearish as we progress continuously, through the year and into next year. So that basically means that any rallies into overhead resistance are going to be met with increasingly more selling as the year goes on, which basically means better shorting opportunities or areas to basically, you definitely, probably don't want to be, too long this equity over an extended period, unless you're just trading up and down and you have your own trading system to do that around that. If you made some nice gains over the past couple of years on JWN, then I do see from this risk map that there is intense risks to the downside. This may not be the worst equity that's on our risk list, but it's certainly one that has been trending upward, where there's been a lot of consumer interest and investor interest, and now it's time for a change. So what exactly are the levels? So to provide some actionable information, but again, this is not a recommendation. This is just information. Okay, so what I'm seeing right now, our initial sell signal came in back around the 2nd to the 4th, which is when Naked Swan Trading put out a warning for all of the S&P that there was going to be some kind of downdraft as we progress through May. And for this specific equity, it did trigger here. This risk map was not provided to the public on the free service at the time. That will be made available to subscribers as we roll out our product line in the coming months. And you should come regularly to nakedswantrading.com. On the side panel, it will indicate all the market calls that we made available to free subscribers, and it will also indicate any new rollouts that are taking place in terms of being able to customize these risk maps for your specific equity strategies or asset classes and instruments of interest. Okay, so right now, going forward, okay, we are seeing a situation where this teal boundary, the upper teal boundary, is acting as a major area has been acting as a major area of support. But once you get on the other side of this teal boundary, and we're awfully close today, like if I zoom in over here, what you're going to see over here is that price, charged down from the sell signal, in the sell, actually, to give you an exact area where our sell signal came in. It came in on a price bar under, like prices trading underneath 56.71. Okay, and that happened basically, throughout the day on May the 4th. Then prices came down to the teal boundary. You could see the teal boundary at that point was between 53.34 and 52.61, and there was a bounce. Okay, but the point is, you could already see higher frequency traders, which are basically the shorter term cycles, projecting through that critical area, which is basically saying, it's not saying that it's going to be there tomorrow, but what it's saying is that at any point you get on the other side of this teal boundary, okay, and it starts off at a level of around 52.77. So you get underneath there for one day, and for just even one trading day, and then you're at risk to having a major sell-off initially down to the 49.47 area, and you get underneath that, and then 44.89, and then you're the broad term objective for that piece of the move is 41.40. Not necessarily on this date, but the key thing to keep in mind here is throughout this entire interval, this teal line is going to act as resistance. So if price gets underneath here and then touches it, that's intense selling pressure, and then new lows. Okay, and eventually what's going to happen is the teal boundary is going to start sloping down. Okay, this is the dominant cycle. Okay, there's also some shorter term cycles. Okay, and the shorter term cycle is related to this pink boundary. Okay, right now the pink boundary is pretty much on par with the upper part of the teal boundary. But what happens is, because these are shorter term cycles, as price starts to move down to this area, this pink upper boundary is going to be moving quickly to the downside, and that will act as a trailing stop for the first bit of the move. Once the second bit of the move happens and this upper teal boundary starts sloping down, it's going to act as the trailing stop. But for right now, this is broad term overhead resistance, starting out as in the 52.84 area, extending as high as 58.42. Okay, but considering that the market made a high of 57.75 recently, there's not that much more of a high, even if the market rallies off of this first big wave of selling in the S&P through May. Even if there was a rally at some point during the year, it's going to be a marginal high, and then sell off. So that's what I mean by the market, won't be taking in any positive news announcements in a very positive way for any extended period. So the bias and market sentiment to new incoming information is going to be turning decisively bearish. Okay? And eventually what's going to end up happening is that later in the year, when the S&P has another major down wave that could start on some sectors as early as, we'll update it as we get there, but it's a rolling thing. But I mean, really, there's a lot of sectors between September 23rd. It could start then, and as late as December the 7th, that it would start breaking down, and then it would just go into a cascade kind of meltdown into the first and second quarter of the year. Taking out the critical level of 39.89 around that time would lead to a very severe correction, which could take you all the way down initially, first to the 33 area, and then even down below $30. So this is it's a heads up because we're at a very lofty level, and whether or not we actually get to that area, it doesn't change the fact that the risks are tremendous, at least down to the first zone, of 41.46. Okay, and from a trading point of view, you could just, a short-term trader could just keep on selling every time it comes into this teal boundary, or in the near term comes into this pink boundary, and then basically and then take profit at the next boundary. So which basically would be like 47.91. Then it rallies in here, take profit at the next boundary, which is basically 46.92. So the thing is, adding up a bunch of short-term trades could end up being just as significant as just staying in a longer-term trade, but then the risks are contained and defined at each step of the way, and therefore the risk exposure is less. So, so by subscribing to NakedSwanTrading.com and getting the critical updates in real time, then that will be something that should interest all of you as we roll out our subscription term basis, and you should come to our site on a regular interval, and you will get that information. So anyways, one other thing I'd like to mention is I'd like to compare JWN to Macy's. So right now what I'm going to do is I'm going to go to the chart of Macy's. It's just loading up right now, and you're going to see that while Macy's is having a reversal, and there was some negative news, and we put out a tweet regarding that there was going to be a risk window earlier today. The initial signal actually took place in here, but the broad term perspective of what's going to take this down is really going to get interesting as we unfold into the end of May. Okay, and it's from a trading point of view, basically resistance, overhead resistance, is the pink boundary, just like it was in the other. So 41.05 to 41.55 is long-term overhead resistance. That's very, very long-term overhead resistance. Okay, so for whatever reason, it gets up there on a spike, which if it did, then it's an automatic, unload. I mean, not that it's not a sell signal right now. It's just that, you always want to be able to enter closer to the top. So the idea is fade rallies, okay? So any rallies that occur, like we had like a little rally this morning, I mean, on shorter term timescales, yes, we provide signals that tell us when this is going to reverse during the day. But on the broader term picture, this pink boundary, you can see, slides down to a level of about 41.70. Well, it slides down to a level of 41.72, and then also 40.82. So, anywhere in that area is major selling, okay, potential. Also, shorter term stuff, 40.43 and 39.60 is going to offer, some good short-term resistance for, day traders that are looking to have this come down and then retest the lows again. Now, it doesn't have to actually rally up because we are in a down wave, in a high risk window into the end of May. So basically, what that means is that there's risk that this could just end up coming down to this purple boundary. The lower end of that is around 32.64. Okay, there is a longer term boundary. It's not really acting as support, but it's there that may act as a small little thing, balance at 34.98. So there's 4 points, to 6 points of downside risk, but at the same time, if there's a rally, then there's greater potential for gains, because not only are you getting in at a higher level to where the next objective is, but you're also getting in closer to where risk is contained over that interval. And even as you extend into July, risk is contained into 43.30. Okay. Now, any boundaries that you see that are sloped down act as short-term support. So you can see when price came down over here, yeah, this boundary was sloped up, but we didn't have a confluence of boundaries, one next to the other, that was actually sloped up together, and that's where you could get retracements. Okay. But if we do get a retracement, and now let's imagine that, when we update our maps, that let's say this boundary is sloped up and this boundary sloped up, and we take out that level, that's when breakout signals gap down, as opposed to just trading a fade signal at a high that gaps down, because it's easier, to get a continuation move, or I wouldn't say continuation move, but to get a number of bars of sell-off from a high point, okay, than it is to continue a downtrend after having a number of down bars that lead into a breakout point. That's why a lot of breakouts on most systems fail. So the key thing in naked swan trading is we're trying to position ourselves at the key retracement areas so that we're trying to sell into rallies or buy into a market that looks like it's going to reverse off of an extreme. In this case, it's a market that's reversing off of a high. Okay. Now, this is just an intermediate term signal that just goes into the end of May for what I'm discussing. After May, unlike Nordstrom, which has longer term signals, this one would, basically be in no man's land. It doesn't mean that the market's going up or not going to go down. It's going to basically follow the market, and as we give our updates, and if as each sector starts unwinding, then obviously Macy's will be impacted by drops in the XLY, consumer discretionary, or drops in the spiders or the S&P 500 futures. Okay. Now, what I can tell you is, and we will update this map later in the year because we are expecting another big wave where all asset classes start breaking down in December, okay, even though it's going to be a sector rotation of classes breaking down at sporadic periods of the year, like we're in one right now in May, then there's another one for some sectors like in August, and then September, and then November and December, but almost every single asset class is set to be at high risk. From after December through well into next year. And so basically, for another signal to form beyond, this small little piece here, we would actually basically need this purple boundary to come underneath this teal boundary and then start sloping up. But the only way it could slope up again is if price has a retracement after coming down to this level, and then at that point will be bounded by basically the upper yellow line, which is 43.30. So again, it doesn't necessarily have that much more upside even after a sharp correction takes place initially. But what I want you to take home from this is that Macy's is, at least in the broader picture of things, isn't as it's vulnerable, but JWN or Nordstrom is even more vulnerable. And going back to that chart, you'll see why in 1 second. I just want to show you the comparison, because we've got longer term cycles, okay, that are basically in play, riding on top of shorter term ones. So when things actually, get on the other side of this bigger box at 49.42, that's when you could get a severe gaps down or movements down, like to 41 area and into the 30s, and that's like a big drop. Okay. Now I'm going to go to the XLY just to finish up the analysis, to look at the consumer discretionary index, and it's also known as the consumer services index. Tends to have a lot of those equities in it. And what you can see here, very dangerous situation emerging. We've got 3 critical risk windows in the XLY, okay? And that is going to add fuel to the fire on the downside risks of Nordstrom, stock, and Macy's. And that's because you know, a great deal of traders who actually trade the XLY also will act on shorting any big names that are inside of it, and especially if they're weak, which we see Macy's and especially Nordstrom's on a forward-looking basis, that would have some severe impact to the downside. So this obviously, this high-definition risk map right over here does not bode well for the U.S. economy as we push through the second, third, fourth, and right through next year, second, third, and fourth quarter, this year through next year. And why do I say that? Well, this is a very dangerous box over here, okay? And that box basically, you know, begins right where we are, okay? It's really, everything really started on the 2nd and 4th, and especially after the 7th, and we put a number of market tweets out and video alerts on nakedswantrading.com. You can see the tweets on the side panel, in the mint-colored side panel on the right-hand side of the screen, or you could go to Naked Swan Trader on Twitter and follow those tweets. It's also you know, broadcast to my LinkedIn website, which basically is under Efrem Hoffman, and you should be able to you know, get those kind of updates. So going back to this chart, what it's actually telling me is that between now and of course, you know, September, and then even more, you know, and then of course going into January 18th, 2013, we've got some zones here, some very critical break zones. Okay, I'm first going to talk about the break zones, and then I'm going to talk about the retracement zones where traders could actually look to fade the market. But from the broad picture, you know, 4150 is critical support, you know, going into the September the 10th to the 23rd period. Okay, from now into that period. Now beyond that period, so let's say, you know, after December the 12th, you know, and going on, you know, through the end of January, any time price gets underneath 42.58, while being above that level, you know, for at least one day, and getting underneath that level for one day, 42.63, there is initial gap potential to the downside to 33.88, and then secondary potential into the 20s. Okay, so that's a 40% haircut. Okay, now in the near term, here's basically what has taken place. What's taken place is there was a short-term cycle over here, and there's a mid-term cycle here. This is the big cycle here. Okay, and basically in this cycle, long-term overhead resistance is capped at 47.11 to 47.04. Okay, but for the very near-term cycles that we have over here, this pink line is going to act as resistance. So as it starts coming down, price, you're going to see price, you know, capped in the 44.49 to 45.05 area, you know, and then if there was some great news, you know, everything is starting to slope up, you know, after the 25th. So there's a confluence of resistance, you know, between 45.34 and 46.38 that's going to make it extremely difficult for any kind of sustained buying, and the market will reverse back down. Now what's going to end up happening is, as you could see, just as when we were showing the Macy's or JWN chart, when price comes down off of a high and comes into pivot points, because it's already expended short-term energy coming down there, you would think it would be natural to have a small retracement, and we had a small retracement, but that's not the case all the time. Sometimes pivot points are breached and moves continue. In the context of this risk map, when you have the lower boundaries which act as support when they're sloped down, and if you don't have two boundaries that are both sloped up at the time while price is coming down and breaking through the pivot point, that's when you could get intraday or dead cat bounces while in the broader term sell signal. But you could see somewhere after May 25th and possibly after June 7th, if this red line and the white line, which are two boundaries in confluence, starts sloping up and then price gets underneath 43.23, that's when you could get the gap down to the next level. Okay? And the next critical level, as I indicated, is 41.53. All bets are off if you take that point out. Now, natural retracement points, if you were to take that out on the other side of the market, would basically, you'd be basically dealing with 44.16. And then, of course, the long-term overhead resistance of 47.11 remains right through the year. So what I'm trying to say is that anytime you're inside this box, you are in danger of giving up your gains and having some severe downside risk. So is it really worth it to try to, okay, get back into the market if you're not a trader, okay, and as an investor, and then just think that things are great because, the market then rallies back if there ever was good news again after the May period and it goes to 47.11. Then it's like, okay, you're all happy because there's gains, but then the market's going to get whacked again. And when it gets whacked again, the risks are greater now because you're now getting into a confluence of two risk windows breaking at the same time. And again, any boundary that is sloped down acts as support. So you could see starting in August, if for whatever reason we got down there's going to be a heck of a lot of support between 35.37 to the level of 33.38. But once you pass this period, which is February 7th, right through the second and third quarter of next year, if you get underneath 33.32 for more than one day, you are at risk to going down into the 20s, the mid-20s. And given that we're at 44, this is an index. So usually if an index, falls 40%, the downside risk to an equity could be just multiples of that. I mean, you could only be, you can't be over 100%, but, you could be over 70%. So there will be some equities that will suffer those kind of losses if those critical levels are breached. But in the meantime, what you should take home here is that whether or not they're breached, active traders could take advantage of selling into resistance, taking some profit, and then if critical levels, like the first one of 41.54 is breached, then you could start trading between the wider bands. But for longer term investors that aren't active traders, they could use this teal boundary basically as an area to basically time their exit strategy out of being on the long side before the market melts down, especially for all equities after December and surely after January of next year, where there'll be a liquidity crisis most likely. I mean, you got to break those key levels first. Now, again, this is not a recommendation. This is an informational alert, and anyone that is not attuned to trading, should consult some advisor that could help them, make a determination of what to do with their portfolio, even if they are attuned to trading. Use this information at your own risk. But what I can tell you is, if you continue following us on NakedSwanTrading.com, listening to our updates, you will see that there is some real value that could be actually gained by looking at these key levels. And over time, I'm sure that you will see that. And we look forward to having you, come to our webinars. We're going to have webinars on a weekly basis, depending on the number of followers on that specific week. And if it's beyond a certain threshold, we will have it, and we will send a notification out. So basically, you could go to the top of our website at nakedswantrading.com, type in your name and an email, and then we will send out alerts regarding interesting market situations, interesting product updates, as well as webinar dates. Those dates are also available on our webinar calendar on our website at nakedswantrading.com. I'd also like to mention that recently an article on Naked Swan Trading has been printed and published in Traders World magazine, the 51st edition. It was available as of this past Monday, so anyone who either subscribes to it could actually view that, or if others would like to view that, then you basically could go to tradersworld.com and I guess subscribe at their website for the magazine, and you should be able to see that article. So I thank you all for listening to this update on the Consumer Discretionary Index, as well as the key equities to be watching, Macy's in the short term, and in the short, intermediate, and long term, JWN, which is Nordstrom. Thank you.